In the last few months, Verizon, which is the stock we're talking about today, has dropped from about $50 per share to its current share price of $37, and in the mid seems to have become a less favorable investment than AT&T, which is something I never thought I'd see. From the start of the year until now, Verizon's share price has dropped 30%, which has sent its dividend yield skyrocketing to now over 7%, which is considerably higher than usual. And in today's video, we'll be discussing all of this in more detail, and I'll explain why I'm adding more shares of this high-yield dividend stock right now. But first, in case you're new to the channel, my name is Ryan Williams, and here we strictly talk about dividend stocks and how you can invest in them to create passive income and reach financial freedom. So if that's up your alley, and if you're on a mission to retire early, then hit that subscribe button. I'd love to stay in touch as we both continue to grow our portfolios and collect that cash flow. Now, while Verizon's share price has been at a steady decline since July, things really started to take a turn for the worse after their recent Q3 earnings report, which on the surface actually looked pretty good as they beat on both the top line, which is the revenue right over here, and the bottom line, the earnings per share right over here. However, guys, as one of my heroes, Rocky, says,
"It ain't all sunshine or rainbows."
And a deeper dive into the earnings will lead us right to the trouble. Despite beating financial expectations on both the top line and the bottom line, Verizon posted subpar subscriber numbers and a higher turnover rate as a result of price increases. And on that note, the company's CFO, Matt Ellis, had this to say. As expected, the pricing actions we took around administrative fees and metered plans led to an increase in disconnects. With certain price ups being phased in throughout the third quarter, we would anticipate some disconnect pressure to carry over into Q4. So not only did we see a higher churn rate here in Q3, but the effects of the price increases are anticipated to be carried over into Q4, which is something we'll just have to keep in our radar going into next quarter. However, despite the increase in disconnects here in Q3, Verizon was able to increase their average revenue per account by nearly 4% year over year, which helped them see an overall jump in revenue by the same amount, 4%. Having said that, the market still responded negatively to the news of decreasing subscribers in this segment, and as a result, we saw the stock dip down to under $34 per share, which is the lowest it's been since the end of 2010, which honestly, guys, it wasn't even so much that Verizon saw a higher churn rate, which, yeah, is not ideal, but the real nail in the coffin was that its closest competitor, AT&T, likely swooped up a lot of that business as they saw a huge jump in subscribers this quarter, far outperforming Verizon. As a result, we're seeing all of these headlines coming out suggesting there may be a new sheriff in town, and for the first time since I've been an investor, AT&T is looking like the favorite in the industry. And to add insult to injury, the earnings report also revealed a decrease in free cash flow year to date compared to the same period last year, which is especially important for us dividend investors to keep an eye on, as the free cash flow is what they use to pay the dividend. Luckily, the dividend coverage is still there for now, but the ice is getting thinner as the free cash flow payout ratio has gone from 45% in 2021 to now 65% so far in 2022, which is okay, but it is something we'd best keep an eye on moving forward because we don't want this to get too much higher, and ultimately we prefer that lower free cash flow payout ratio. Personally though, I still feel bullish about Verizon, and I'm actually adding more shares to my portfolio while the stock is so down. You guys can see my Verizon position right here. I basically have 43.9 shares at an average cost per share of $51.40, which is quite a bit higher than the current share price of $37.78. There's a near like $14 spread there. And this puts me at an unrealized loss of 26.5%. And over the last few months, guys, I've been actively trying to bring down my average cost per share. If we pull up my tranches right here, it's been a few months since I added any Verizon, but I started buying some again this week. I picked up 3.3 shares. And then prior to that, I was adding shares in August. I added shares in July as it was coming down, even in May. So throughout the course of the year, I've been slowly but surely adding to this Verizon position in an attempt to bring down my average cost per share, which in doing so would increase my margin of safety. And just a rule of thumb for you guys, the closer that your average cost per share is to zero, the more downside protection you have and the less valuation risk you have as an investor. I need to be careful though. I don't want to be too overweight in Verizon and have too much in my portfolio. But if we take a gander at the diversification, guys, I mean, the communications sector as a whole is really only 9% of my total portfolio. So that's not anything too crazy in my opinion. And if we break that down on an individual basis, just looking at the two stocks I have in that sector, AT&T is about 4.75%. And then Verizon's even weighted less. It's just above 4% of my total portfolio. So looking at it from this perspective, guys, it appears that I still have some room to add Verizon or AT&T if I even wanted to. It doesn't look like I'm too heavily weighted in either of these positions. But if we scroll down and take a look at how my portfolio is weighted by income, we see a little bit of a different story here. It's actually going to be a little more heavily skewed towards the communications sector, which makes up about 12% of the income that's being generated in this portfolio. And if we look at those two individual holdings, AT&T brings in about 6% of the income in total in my portfolio, and Verizon's is now just above 6%, which still isn't really too bad. But I have 23 holdings in total, and within all of those holdings, there's probably room to better balance out where the income's being generated, if that makes sense. And just talking about the communication sector as a whole in my portfolio, I'm not sure how much more I'll want to increase that weighting because, you know, while the high yields that that come from both of these stocks, AT&T and Verizon, are pretty great, which we'll take a look at Verizon's dividend stats in just a moment. I really do want to prioritize higher growth dividend stocks. And as you can see, Verizon is definitely lacking in the dividend growth department. I mean, it is nice to see their yield over 7%, but I also want to make sure I'm putting myself in a position to see my income grow more rapidly over time, which is something that will be harder to accomplish with Verizon, who has a low dividend growth rate of 2.07%, even though they have a nice growth history of 18 years. The thing about the dividend yield though, guys, which makes it really tempting, is that not only is it currently sitting nice and high, but this dividend yield is so far above where the average yield currently sits for this stock. Verizon's 5-year average dividend yield is 4.6%, and where it's currently at now over 7% is 52.62% higher than that average. And the only way the dividend yield can get so far high above the average is if the share price dramatically comes down, which is something we saw with Verizon, but we have yet to take a look at Verizon's actual valuation, which is actually pretty good right now. Seeking Alpha gives them an overall valuation grade of an A-, and that PE ratio is looking nice and low, 7.19, which is about 50% lower than the sector median, and it's about 35.7% lower than the company's 5-year average PE ratio. If we scroll down to the bottom of this page and take a look at a couple more metrics, the price to cash flow right there at the bottom is 4.11, which is also nice and low, 52% lower than the sector median, and just over 33% lower than the 5-year average price to cash flow. And the last metric we'll look at is the forward price to book, which is 1.72, not too bad, about 10% lower than the sector median, and a whopping 50% lower than the 5-year average price to book. And on that note, if we go over to the balance sheet and scroll down to the bottom, let's take a look at how the book value is growing over time. So on a per share basis from this chart right here, guys, we can see that from 2014 to 2021, Verizon's book value per share is seeing a really aggressive increase. As far as what to expect next from Verizon, because the sentiment seemed to be shifting with the stock and falling out of favor, I wouldn't be surprised if Verizon traded flat for the time being, or even just stayed compressed while AT&T continues its ascent. But really, guys, anything can happen, and Wall Street analysts give it a high price target of $68 per share, which is considerably higher than where the stock is currently sitting, almost double. They give it a low price target of $33 per share, indicating that there is some more compression to potentially be found, and they give it an average price target of $45.90, which represents a near 21% upside from where the stock is currently sitting. No matter what the share price does, I'm still confident in Verizon's ability to generate income for shareholders and still see a lot of good in the business despite this quarter's increase in disconnects. They have a number of other segments in the business that are still continuing to grow, like broadband, and in the recent earnings call, they announced a pretty big cost-cutting program that they anticipate will save them between $2 to $3 billion per year by 2025. And as far as the share price goes, guys, we'll just have to see what happens. Truth be told, I'm not holding my breath for Verizon's share price to shoot to the moon anytime soon, just because it doesn't tend to grow in that regard. There are some stocks out there like Apple that offer high share price growth with low dividend yields. There are some out there like Starbucks with lower yields and high dividend growth. And then there are ones like Verizon with higher dividend yields and steady dividend payments that you buy just for the income. And as long as it continues to serve that purpose in my portfolio, I'll be holding on to it and, likely will add more over time. So now that you've got my take on Verizon, you're going to want to learn about these next 3 stocks right over here, which are also ridiculously discounted and look like the best pickups right now in the month of November. So check them out right here, and I'll see you in the next one.